Hello, welcome to all. In continuation with the last class, we are discussing standard costing up to learning curve effect, learning curve variance we are completed. Now we will see that relevance cost approach to variance analysis. Variance analysis. Here variance analysis to compute variance based on total cost. What is the total cost we have and production inputs we have, total standard cost we will apply this. This is failure to use limited inputs properly lead not only increase acquisition but also loss of contribution. Therefore it is necessary to consider the last contribution also in variance analysis. So we will consider last consideration. What it means by last consideration means this is like as opportunity cost. This is like as opportunity cost. If you are doing one business and you want to shift, you for example your normal capacity was 1000, normal capacity was 1000 and for internally we want to use 200, internally we want to use 200. If you produce this 1000 we will get one amount, that is I think 20 rupees we will get, but if we provide for internally we will get only 15 rupees. For 5 rupees here we will have variable cost will be maybe 10 rupees is variable cost. Here we also 10 rupees variable cost. So 15 rupees, 5 rupees we will get profit. Here we will get 10 rupees profit. There we will lose the contribution. 5 rupees lose the contribution. So this is also we will consider here where variance is there. So we will not consider only the material variance and not for only labor variance, not only variable overheads. We also consider the last contribution also. Next, variance through throughput accounting. Variance through throughput accounting. Here relevant cost approach. Where relevant cost approach means another lane where variances inputs are limited. Here we have inputs are limited and where for the failure to use limited inputs we have limited inputs, so that we are failed to use that limited inputs properly lead not only increase acquisition cost, so we will increase not only the acquisition cost and we will lose the contribution. So when you not use properly your inputs and we want to purchase again, then you are purchasing small quantity, your purchase cost will be increased, cost of acquisition will be increased, not only the cost of acquisition but also the you will lose the contribution. It is necessary to consider the last contribution to various analysis. This is the case, that is relevant cost approach to various analysis. Next, where what is this variance analysis and throughput accounting. Various analysis as no emphasis on constant resources. So we have resources and instead it is based on the efficiency and cost of operation each part of manufacturing system rather than ability the entire system to generate profit. This is the case of variance analysis and throughput accounting. Next, variance analysis in advanced manufacturing environment and high technology firms, where if you have a different when you have in high technology environment and large part of manufacturing process is computerized. If it is a computerized, if you are using a computerized, here what will happen, most costs that once were largely variable have become fixed now. So for variable it will become fixed, must becoming committed fixed cost, it will be committed fixed cost. Now some high technology manufacturing organizations have found that two large variable cost involved, that is material and power. When you are using the high technology computers, we will have the involved material and power to operate the machines. This is the most large variable cost. This is made when using computers. Next, in these companies the emphasis of various analysis is placed on direct material and variable manufacturing overheads. For these firms, labor variance may also no longer be meaningful because direct labor is committed cost, not cost expected to vary with output. So here much of manufacturing labors will consider highly skilled labor. For computers means we will require some professionals, computer skills knowledge persons. We will not work with unskilled persons. So your cost also committed cost. Here also largely committed cost will be labor cost also become. Next, firm does not take any risk for losing high trained persons even during the economic downturn. The result is less direct labor and more overheads. Next, standard costing in service sector. In service sector, what is there here? Here use of activity based on costing. Costing can provide a constructive base for variance analysis of overheads in service sector organization. Service sector will use the activity based costing ABC base, and it provides the constructive basis for variances. That is standard costing service sector. So here what is the service sectors like industries, for example accountants, solicitor, dentists, hairdressers, transport companies, hotels. Their service industries comprises a wide range of different businesses and different sizes and different type of services provided. Next, standard costing and variance analysis is more tough to apply service sector organization, as their major portion of their cost is comprises overhead expenses rather than production expenses. For services they do not have more production expenses. For cost sheet we will have more preference for manufacturing units. While traditional variance analysis of overhead does not deliver very useful information. In traditional information we do not have any measure because we have only the standard and actual comparison for where we will go for traditional analysis. Next, overhead control purposes. Application of activity based costing. So we will use the activity based costing for service based sectors. Then it is effective base for variance analysis. So time and efforts in the implementation of MIS concept insight. McDonaldization means here breaking the task into small possible units. We will break the task into small possible units and rationalizing them to find single most efficient method. So for completing each task we will break the all tasks, and from each task we will see single most effective method which is completing the each task. This is the case of McDonaldization. Break down into small tasks and repeated until all tasks have been break down and smallest possible level. Here we will see the single most efficient method for completing each task. Next, here all other tasks are discarded. Whichever is not efficiently working we will discard all other methods which is deemed inefficient. Next, we will see that here it will helpful in services like hairdressing, dentist and optimization services. Who is the service providers is there? No, for them it is accurate and set ascertained. It is better for them. And standard costing in public sectors. In order to cost control in public sector, that is example street cleaning, refuges to disposal and so on, regular variance is required. Actual unit cost should be calculated on monthly basis and compared with estimated unit cost. To achieve this comparison, information need to be maintained about the units of service adapted. What are the services they are adapted? They must maintain. What are the services are maintained? For example, statistics would be maintained on the number of visits made and the number of hours worked. So they will maintain the number of visits they have made and number of hours they have worked. For necessary detailed information they must maintain. Next, actual monthly cost should be taken for the organization financial management system, and each month financial report should be produced which offer an accurate image of budgeted versus actual expenditure. This report are must for budgetary control. Actual expenditure reported on financial system may require some modification to take into account. That is like trade payables, that is service bill, used bill unpaid which is unpaid, accruals, services used but bills yet to be received, time differences, some costs are not incurred evenly over the year. This is related to that. Next, standard marginal cost. Here the standard marginal cost means standard and variance can be calculated based on marginal costing. in profit maximization, MR is equal to MC. MR is equal to MC. We have seen in last time in I think last chapter which we discussed price decision. I think so. Price decision we had discussed this. MC is equal to MR, and when we want marginal revenue, we will find out the MC. For that MC, they are providing here. Where marginal costing is used, there is no overhead value variance because marginal cost does not absorb fixed overheads. Fixed overhead expenditure only variance fixed overhead in manufacturing system. Next, here we will calculate the absorption costing system. Inside sales variance. Sales variance can be used to analyze the performance of revenue center on broadly identical terms to those for manufacturing cost. So sales variance way will be used to analyze the performance of revenue centers on broadly identical terms. The most important aspect of sales variance calculation is that they are calculated in terms of profit or contribution. Next, sales directly influence the total profit. So sales will directly influence the total profit. There are more meaningful performance measures will be obtained by the comparing results of sales function in terms of profit or contribution rather than the sales revenue. Next, in standard absorption costing system, where it will be profit margins are used. Selling price SP minus total unit manufacturing cost. Whereas standard marginal cost system, contribution will be used. Contribution means what? Selling price minus unit variable cost. Here unit manufacturing cost for standard absorption costing system. Standard marginal costing use manufacturing variable cost. Next, if marginal costing approach is adopted, sales contribution variance pursued to identify the influence of the sales function on difference between budget and actual contribution. Next, sales function is responsible for sales volume. Sales volume means what? Quantity and unit selling price. So what is the amount of quantity you are selling and what is the unit price you have, that is the responsible for sales functions, but not the unit manufacturing cost. It will not responsible for unit manufacturing cost. The standard cost and actual cost, standard cost and not actual cost of sales is deducted from actual sale price. Next, sales contribution variance. Sales contribution means what? It is actual contribution, budgeted contribution difference between actual contribution and budgeted contribution. It will be the sales contribution variance. Now sales contribution variance will be actual contribution minus budgeted contribution. Here we have taken reverse. See why? Normally we have taken which starts first for all variances in before, but for here sales contribution variance we will see first we will take reverse case, that is actual will happen second time and first we will budgeted, so budgeted contribution. It is the case here. Next, the effect of use standard cost throughout the contribution calculation means that sale variance arises because of changes in those variable controls. Next, here sales contribution price variance will be sales contribution volume variance. Price means price, value means quantity. So what we will take reverse, we will calculate what is the actual first. Actual, if we want price variance, we will take the actual price minus standard price. So standard contribution price into we will take the quantity. Which quantity we will take? Always quantity means actual quantity, always price means standard price. So if you want value variance difference means value means quantity. So actual quantity minus budget quantity into to price. Price means with what? Always standard price will be taken. Next, where a company sells several different products that have different contributions, the sales volume contribution variance can be divided into sales quantity and sales mix variance. What is this mix variance? Means for products you are mixing some other items which is not prescribed, so that mix it was came variance. So that you are mixing some identity another item, so that there is some variance. We will identify that mix variance also. Sometimes if you yield variance also there, then we will calculate that yield variance also for this. So mix variance or quantity variance. Mix variance means actual quantity minus actual quantity in budgeted proportions. No, standard contribution per unit. Standard contribution per unit will be taken. Next, sales contribution quantity variance, where actual quantity in budgeted position minus budgeted quantity into sales standard contribution per unit. So price means always standard will be taken, and here we have mix. Because of this because of this mix we are calculating for this. So actual quantity, what is the actual quantity? Actual quantity in budgeted proportion. Budgeted proportion means if we take 9 lakhs quantity for sales and we have actual position will be 1 lakh, and we will take first actual quantity, and we will take, if we budgeted for 90,000, what will be the actual quantity, we will take in that way, and price into price means always standard price. Next, sales contribution in quantity means always first we will take in actual quantity in budgeted portion minus budgeted quantity into standard contribution per unit. So here when mix variance is there, first we will take actual quantity, and quantity variance means actual quantity in budgeted proportion minus budgeted quantity. Next, market size variance or market share variance. Market size means your market, what is the budgeted market share into actual industry sales quantity minus budgeted industry sales quantity into average budgeted contribution per unit. It will be the formulas, and when we solving the formula we will get the proper idea, and I will give the how to remember that formulas. Next, reconciliation of profit. Here we will see the reconciliation of profit will be budgeted profit to actual. Here we will use the absorption costing. For this absorption costing, from preparing the absorption costing, we will get this format, and we will get this actually reconciliation statements. We have two categories. One is absorption costing way, and another one is marginal costing. They provided or not, marginal costing? Yes, they provided marginal cost second time. First time will be actual. Okay, we will discuss absorption costing first here. Absorption costing, what we take firstly, actually if you see the cost statement, what is there in cost statement, we will see the cost statement will be first of all I think direct material, direct labor. So direct material, direct labor, and overheads and fixed overheads, and we have administration and selling and distribution. So directly we will get the selling and distribution, no information about administration and selling and distribution, we will get the sales. This is the absorption. So what is the actual profit? So first we will take the profit. Which profit? It will be budgeted profit. So we are preparing absorption costing. So absorption costing means we have standard budget profit to actual profit. So we will take the what is the budgeted profit, or we will take sometimes some standard profit. What we are analyze the profit, how much we required. This is the budgeted profit. Okay. After that, what is the direct material variance? We have direct usage variance. Price variance means two prices into quantity. Which quantity? Quantity means always actual quantity. Prices means difference of prices. We will take the price difference. Next, mix variance we will see. From that mix variance we will get the values. Next, labor rate variance, labor ideal time variance, labor efficiency. For this all we have some formulas, and we will get these values. We will take here and we will calculate here, and we will see the what is the budgeted profit and what is the calculated profit, and we will get here profit. Then from this we will see from above to above. Now we will get the actual profit. From this we will get the actual profit. Next, from marginal costing, here marginal costing we will see the budgeted quantity into standard margin. For budgeted quantity into standard margin, in case of absorption we will have here actual quantity. We will take here actual quantity. Here marginal costing means budgeted quantity into standard margin, but in case of absorption costing we have actual. So here we will see absorption costing, budgeted quantity into standard margin, budgeted quantity into standard margin. Here we have budgeted quantity into standard margin. I think they missed something here. Absorption means they will take actual quantity now. See, let me see. Next, variance, direct material, is there any variances, and direct labor, is there any variances, and variable overheads and fixed overheads. What is the variances? What is the standard? What is the budget we have prepared? What is the actual we have got? We will see the variances. Variance means difference. We will see the difference and we will get the standard of profit and we will see the actual profit. Next, they provided absorption costing, third one. So here see actual quantity into standard margin, and first one. Okay. So we are seeing budgeted profits to actual profit, so that we have taken budgeted quantity into standard margin. So next, if we see in third statement 3, we have standard margin, actual quantity. Here from this we are standard profit to actual profit. So when you are actual profit, we will take the actual quantity. When you have budgeted profit, we are comparing with budgeted profit, then we will take the budgeted quantity. So here we will take the budgeted quantity. Okay, next, is same statement, and we will see the direct labor and direct material, direct labor, direct overheads, fixed overheads and sales variance. We will get the profit. When we see the problem, we will get the clarity, and we will see the one problem. Illustration number 4. In illustration number 4, what is they provided in illustration number 4? In illustration number 4, they provided some information. Relating to this information, we require to provide the reconciliation. Here we will see, first we will see the what is we required. So from that we will get the answers. Okay, prepare reconciliation statement of budgeted profit to actual profit. So what we require? Budgeted profit to actual profit through comment on supervisor performance. So when you are taking reconciliation statement of budgeted and actual profits, here we will reconciliation the statement. Firstly, we need to take the budgeted profits. From that we will get the take the favorable or adverse for direct material and direct labor and direct variable overheads and fixed overheads, and we will see all this and we will get the profit, actual profit then. So if it is a favorable, we will add it. If it is a favorable, we will add it, and if it is a adverse, we will deduct that. Then we will get the actual profit. Okay, next 24375. Okay, now we will see what is they provided. Here they provided that well-known footwear is a shop. It has one shop. Okay, and what is it providing? Shop for various shops, various sports and activities like jogging, cricket team, tennis, hockey. They provided the budget profit for WF is calculated considering the average selling price of 500 rupees per shoes, and average cost will be selling price will be 500 rupees. So they provided the selling price. Okay, for that we will get the sales value contributions. We will get from sales value contributions, and they provided the average cost, that is variable cost they provided, that is we will see. Next, the supervisor of WF has discretion in staffing and in setting prices. As usually the WF is staffed for 650 hours. So how many hours he is staffing? 650 hours per month. Next, at budgeted rate will be, what is the budgeted rate? 125 rupees per hour. In addition to this, base wages, that is related to direct labor. So up to this we provided, and now they providing related to wages. Staff get a payment equal to 5.5% of taking. Moreover, staffing levels are not expected to change in response to retail changes in shoe sales. For September 2020, the WF had budgeted sales of 2,250 pairs of shoes and 650 staffing hours. Okay, actual results we required for the September 2020 were as follows. So actual results were provided. What is the actual results? That is, pairs of shoes sold 2,500, revenue will be 12 lakhs, and less cost of shoes will be 8,25,000. Staff additional payment will be 66,000, and less staff base wages will be 125 rupees per hour, and they got the profit. Okay, from this we will calculate the reconciliation statement. Okay, we will calculate the reconciliation statement. Just a second. For September reconciliation statement, for working, we will see the working first. Here what is they provided? Budgeted data, we provided budgeted data, and we have actual data. From that we will get the profit. We require budgeted profit first. So that budgeted profit, we will get that how many units is there. 2,250 pairs. They provided 2,250 pairs. Okay, we will take that 2,250 pairs for budget, and actual they provided 2,500 actual provided. Okay, and what is the price per unit? They provided for actual 650, and they provide 350 average cost. Selling price will be 500. So that amount will be 500 for selling price, and variable cost will be 350, and they provided one commission will be how much rate were they provided commission. 5.5% was taking, staff getting a payment equal to 5.5%. so this is the commission we will take here. We will consider the commission. Now after the selling price per unit and cost we will deduct, and commission rate we will deduct, we will get the contribution. Now contribution into units, we will get the revenue. What is the contribution? 122.5. Okay, now we will see the revenue will be what is the selling price? 500 into what is the units? 2,250. so for 2,250 into 500 we will get the revenue. Now cost of shoes will be, and they provided the cost of shoes will be 350 rupees. 350 into 2,250, it will become 78,500. and staff additional payments, that is there is their commission, that is 27.5 into 2,250, that is 61,875, and less staff based wages, so 81,250. This is budgeted profit. This is budgeted profit, and 2,33,875 which is actual profit they provided. So we will get this actual profit. We will take the budgeted figure, and we will provide this reconciliations. How much we have reconciliations? So this is budgeted figures. So we got the budgeted figures. Now we got the budgeted figures. Cost of shoes will be 7,87,500, and here first we will see what is the profit variance. 2,30,870. For in case of sales, we will take the reverse. What is the actual minus budgeted? So 2,30,000 minus 1,94,735. It is a 36,500, which is increased based on through the budgeted. So we will get the 36,500 favorable. Next we will see the contribution. We will see the contribution difference. What is the contribution difference? That is 122.5 into how many units we have? 2500 units. 2500 units. So 2500 units minus here for contribution we will take the 2500 minus 2250 into standard price we will take up. Standard price we will take always price means standard price. Always price means standard 122. So what is the standard price? 122. So 122 we will take up. Next, that is contribution variance. Now sales variance. Sales variance means sales price variance means what is the prices we have? Prices will be that is 500 480. So 480 minus 500 and we will take the into quantity. Quantity means always actual quantity. What is the actual quantity? That is 2500 will be the actual quantity. 2500 will be the actual quantity. Next, cost variance. Cost variance means we will take the difference of cost. What is the cost we have? That is we have for cost per pairs. That is 350 minus 350 minus 330. 350 minus 330. That is cost into quantity we require. Quantity means always we will take the actual quantity. So into actual quantity. Next, price means always standard price. Quantity means always actual quantity. Next, staff cost variance commission. What is the cost commission? Cost of commission, that is they provided that 61,000. What is the rate is there? Here we will see. So we will have 27,050, 27.50, 26.40. So 27.50 minus 26.40 into we required quantity. Quantity means always 2500. That is actual quantity 2500. Next, staff cost variance. That is base wages. Base wages. What is there? We have directly 78,000. That is 81,250 budgeted minus 78,125 budgeted we will take up. So staff cost variance we will take the base wages. Normal cases. That is the case. Budgeted 350 budgeted. Next 480. Only the here the price. This is sale price. That is right hand side. So for if we take the PNL, if you have this side, we will take actual minus budgeted. If you have this side, we will take budgeted minus actual. If we see shoe cost, means shoe cost will be 350. Here we will see 350 minus 330. 350 minus 330. That is budgeted minus actual. When you have a price, actual revenue minus revenue. So it is the right side. So we will think on a right side. So we will come with the back side. What is first we will take? Actually first we will take standard, and if second we will come actual. When you go for right side, we will go for reverse case. That is the case. Next we will get the all variance we have got. From all variance we will put here, we will get the answer and we will get the actual profit we will get. Next, what we required now, comment will be required. What we required to comment, the performance seems to be good, because what is the difference is there now? 1,94,375 minus 2,30,875. There is only 36,500 is different. 36,500 is different. Here it is performance is good. It will show that supervisor of WF passed on 5.7%. We will provide the cost percentages for each, which is there no, for cost variance how much percentage is there for to customers. Same is also revealed through entire offsetting cost variance and price variance. Now shoe cost will be decreased by 20 rupees per pair for standard cost. That is 350 is there budgetedly, and we have actually 330. So it was ready. So it is our favorable only. When the cost is decreased, then it is your favorable only. No. Next, additionally, the selling price decreased by 20 rupees per pair for standard price, 500 rupees per for actual price. It is not our when the our selling price was decreased, it is not our favorable, so we have taken the adverse case. Next, the reduction in the selling price appear to produce favorable sales volume was variance reasonably increased. So our sales volume was increased. How much volume was increased? Here we will see. For actually we have taken budgeted will 2250, but volume was increased 2500. Even though selling price increased, we have increased our volume also. Our price was decreased, selling price was decreased, we increase the quantity, we will get the normally. Next, another one, since reduction in the selling price, staff commission were also very low than the budgeted. Moreover, 500 reduction in revenue lead to 0.055 into 50,000, that is 2,750 less in commission cost. This is related to commission cost. Lastly, staffing was 25 hours under budgeted, leading to saving of 25 into 125, that is 3,125. Next, overall it appears that manager has done a good job. He is done a good job. When he is done a good job. So next question number 5th. What is there in question number 5th? See, we will see. Oscar Manufacturing Company, OMC, is leading consumer good company. The budgeted and actual data of OMC for the year 1819 are as for the year 2021 are as follow. Say they provided budget, they provided actual variance, they provide the variance. How we get that variance? 2 lakhs minus 1,65,000. You will get the variance. What is meant by variance? Variance is nothing but difference only. So they provided what they provided: actual production, sales production. So they budgeted for 2 lakh units, but actually they taken only 1,65,000 units. There is 35,000 difference. Next, sales 21 lakhs was budgeted and actual was 16,92,900. Next, where variable cost will be 12,66,000 and actually it was 10,74,150. Next, fixed cost will be 3,15,000 and actually it was 3,30,000 and profit will be 5,19,000. So we have the variances, difference of variances we have. Okay, now what we did now, the budgeted data shown in the above table is based on the assumption that total market size would be 4 lakhs units, but it turned into out of 3,75,000 units. So the above budget was provided based on 2 lakhs units. Now based on assumption that total market size would be 4 lakhs units, so they provided based on 4 lakhs units, but it turned out into 3,75,000 units. 3,75,000 it was turned. Okay, so what is their budgeted market share? What is the prepare statement showing the reconciliation of budgeted market? Now firstly we will see what is the budget market share here. Budgeted market share means 2 lakh will be budget, but actually it was 4 lakhs, budgeted for 4 lakhs, and in year 1,65,000 divided by and 3,75,000 will be the actual position. So they budgeted for 2 lakhs, actually will be 1,65,000, but it was turned based on total market size. Assumptions was provided 4 lakh, 3,75,000. So 2 lakh divided by 4 lakh and 1,65,000 divided by 3,75,000, and here the percentage will be 50% here in budgeted case, and here we actual market share will be 44%. Okay, and now what we will see now, we want reconciliation statement. We will calculate the contribution. What is the contribution here? Contribution will be, first of all we have sales will be 21 lakhs, sales will be 21 lakhs minus 12 lakh 66,000. We will get the contribution here. We will get the contribution here. Okay, based on this contribution, how much we will get the contribution? I like 21 lakhs minus 12 lakh 66,000 means 8 lakh 34,000 we will get. 8 lakh 34,000. 8 lakh 34,000 divided by for how many for budget 2 lakh units. 2 lakh units, this will become average budgeted contribution per unit. Next we will go for standard budgets. Standard sales price. Standard sale price. What is the standard sale price? Sale price will be 21 lakhs divided by 2 lakhs. We will get the selling price. Next actual selling price will be 16 lakhs 92,900 divided by 1 lakh 65,000. We will get the actual selling price. Now we will see the standard variable cost. What is the standard variable cost? 12 lakhs 66,000 divided by 2 lakhs, and we will see the actual variable cost. Variable cost will be 10 lakh 74,150 divided by 1 lakh 64,000. So we will get the each cost. We will take this each cost. Now what we require for after the each cost is taken, now we want to provide the reconciliation statement. Here they asked for reconciliation statement. For reconciliation statement, what we will get? We will start with budget and we will reach to 2,88,750. That is the case. Okay. We will take the 5,19,000 and we will do the some adjustments. Whatever the adjustments is there, for that adjustment we will get the actual profit. Actual profit is 2,88,750. Now we require to provide the variances. So that we will take this budgeted profit and we will reach the 2,88,750. That is 2,88,750 we reached. Okay, actual profit. We need to adjust this sales differences. Whatever they provided now, sales volume is contributions, planning variance means budgeted to budgeted, this budgeted to this budgeted, and operational variances now this revised budget to actual, and sales price variances now what is the price variance? We will calculate it here sales price, and variable cost we will calculate sales cost, variable cost. So next fixed cost, we will calculate the fixed cost per unit. Based on the cost we will calculate it. No, we will calculate here. What is there here? Firstly we have budgeted market share. How we will get the 2 lakh divided by 4 lakhs? We are got the 50%. We are calculated. Next actual market share, it like 1,65,000 divided by 3,75,000, that is 44%. This also we have calculated. Next standard costing, budgeted contribution we have calculated. We have got the 8,34,000. So average budgeted contribution per units. So we will calculate the all units will be per units. Per units it will be 8,34,000. It is related to budget, so we will take the budgeted quantity. Next when we want standard price, that is budgeted sale price will be 21 lakhs sales divided by 2 lakhs, that is quantity, and we have calculated this also. Actual sales means actual sales divided by actual quantity. Next standard variable cost, what is the variable cost we have and divided by total quantity, and actual variable cost means actual variable cost divided by total quantity. This is 6.5 rupees. This is we have got the all rates, that is 4. In case of 4.7 in budgeted contribution, standard sale price will be 10.5 and 10.26 for actual sales. We will get standard variable cost will be 6.3, actual variable cost will be 6.8. Here these prices where will be useful for calculations. We will take the all standard price which is useful for calculation purposes. So we will see here. We will calculate the variances now. Firstly we will calculate value contribution planning. Here for contribution planning, what is the rate for standard? 4.7. So we will take 4.7 here. 4.7 here. So into which is we will take market share. We have calculated market share, 50% is market share when we are calculating for volume of contribution, and this is planning. So budgeted 4 lakhs, 2 lakhs divided by 4 lakhs we have done 50%. when you go for operation, we have done for actual also, that is I think 1,50,000 something is there, no, they we will got the 44 percentage, 44 percentage. We will see the difference of 44 percentage and 50 percentage, 50 percentage. So actual market share minus budgeted market share, and we will see the 2 lakhs 3,75,000 units into 4.7. Here also 4.7, 4.7. Always we will take the standard price for anywhere, and we will get the actual quantity here, and actual quantity when your operational he is doing, we will take direct operational units. And where you are calculating for contribution planning means, then you will require to provide 3,75,000 minus 4 lakhs, that is this 3 lakhs. So this is actual minus budgeted. When you are for planning stage, we will take difference. When you are in planning stage, we will take difference, that is actual minus budgeted. But where your operation you are already worked, we will take directly actual quantity into standard price. So we will get the variance. It may be favorable or adverse. We will take it a favorable or adverse. Next, after that, value of contribution after, we will calculate the price. Price means what? Price difference. So selling price will be right hand side. So actual price minus standard price, and we will take the quantity. Which quantity we will take? Quantity means always actual quantity will be taken. Actual quantity will be 1,65,000 units. Price difference will be actual price minus selling price. Next, variable cost expenses, cost variances. Cost means what? This is left hand side. So left hand side means we will take the which is first arise, that is standard cost minus actual cost, and we will take the quantity. Quantity means always actual quantity, actual production we will take. Next, fixed cost means we have budgeted fixed cost, actual fixed cost directly, so we will take directly. And this variances, whatever variances we got, we will provide here, and we will get the actual profit. This is the question number 5, I think. Question number 5. Okay, now we will see investigation variances. What is this investigation variances? Means when you have variance, then you will investigate. Here we will see investigation should be only be undertaking if the benefit expected from investigation exceed the cost of searching for and correcting the source of variance. So investigation should be taken only we will get the benefit. What type of benefit? It must be the benefit will be exceed whatever the cost we incurred for investigation. So for example, if for appointing one person for investigation, we will pay for him 20,000. So after investigation we will get 5,000 rupees. It is not good for taking the investigation. If you have expectation that you will get 1 lakh rupee from out of that investigation, you can appoint for 20,000. This is which exceed your cost, for searching and correcting the source. Next, interpretation may be suggested possible cost of variations, but investigation must arrive at definite conclusions. For variances, for differences, they may tell the story. Sir, if you ask the production manager, purchase manager, why the difference is got here, he will tell the story. There is price difference, there is quantity difference, there is some different discounts. That is, they have many reasons for variance. But in case of investigation, we will come for definite conclusion. That is why there is a difference, means you will tell the correct reason. Due to heavy rain, due to COVID, that is, if you investigate only, we will get the conclusion reason. So we will get the definite reason. We will get the definite conclusion here. And here about the causes of variance, so that we will take the corrective action. So we will take the action to correct the variance can be effective. So here they provided that interpretation may suggest possible cause of variations, but investigation must arrive at different conclusion about the variance, so that actions variance can be effective. This is the case of investigation in variance. Next, what are the factors to be considered when investigation variance is there? Must variance, we will see them. For you are appointing for one person, you are paying for 20,000, but your turnover is, your business is too small size, so we will consider the size of your business. If you are a small variations seen from standard, then ignore, not to investigate. If you investigated, you will ask for that person only. Yeah, why will go for investigation? That loss is better now. See the size of organization and limit establishments. What is the size of variation? If it is small variation, you can ignore. And type of variance, which type of is variance is there? It is adverse variance is given more importance by the organization. Overall favorable variances seen with the regard to the estimate. Next, we will see the cost. Cost associated with the undertaking of investigation. If you require for 2% for investigation and you will get from benefit is only the 10,000, then cost is more, so just ignore that investigation. Next, pattern in variance. What is the pattern is going? You will monitor over a period of time, and if the variance of a particular cost, so there is a cost, we will see in variance is always in advertisement, selling and distribution. What is going in advertisement? They will tell advertising is providing, sir. Advertising is provided in newspaper. Advertising is provided in TV. Okay, TV. Open the TV. They will tell, sir, last year, last day, last month, they will tell like that. So that we will see the pattern on variance. Which expenditure is variance is going more, and what the reason is telling there. This is, we will see the pattern of variance. Next, budgetary process. In case of budgetary process, it is uncontrollable, unrealistic, then that case investigation should be re-evaluating the budgetary process. So for factors which we will consider the factors: size of variance and type of variance, cost of variance, pattern of variance, and budgetary process exist. Next, methods used for variance. What is the methods we will use? First one will be simple rule, that is thumb model. It is like arbitrary criteria. If the absolute size of variance is greater then certain amount, or if the ratio of variance of the total cost exceeds so predetermined percentage, then managerial judgment and do not consider the strategical significance, so they will follow certain percentages method. If you crack that method, and they will see the why the investigation is required. This is investigation is required for variance is happen, so they will kept 20%. So selling distribution is going to budgeted to actual 20%, so it will require for investigations, or they will go for statistical method also. That is, two mutual exclusive states are possible here. First assume will be that system in control, or if another one, here we will go for variance in simple due to random fluctuations and around the expected outcomes. Next, second possible will be in out of control, we do not have control on that, and then we will take the corrective actions can be taken to rectify the situation. Next, here investigation is undertaken when the probability that an observation come from in control distribution fall below the some arbitrary determined profitability level. Next, possible interdependent between variances. This is possible interdependent between variances means where and using cheaper material. If you are using cheaper materials will result in favorable material price variance. Then, but using cheap material in production might increase wastage rates. So, if you are using a cheaper items, for example, they provide interdependence between variances. So some dependence is there which is using for if you are using a cheaper material, it will be provide pure quality and material price variance will be come and it will be favorable, but it costs more wastages. Price will be decreased, so that you will get the price variance and you will save the price. But when you go for quality, wastage material will be outcome more. And if you are using skilled labor to do work will result in adverse labor rate variance, but productivity might have higher as result due to experienced labor. This is possibility of interdependent. It will depend on another factor. It will depend on another factor. One will become. Next, changing composition teams might result in cheaper labor mix, but lower productivity will come. If you are changing person, if one person is sitting ideally in reception, he will for that he is sitting in ideal. So what we doing? Oh man, come and do your work. We will telling like that. You don't know about the work, so productivity will be less, lower productivity for taking that person into the work. Next, worker trying to improve productivity in order to get bonus, so they will depend on morely bonus, might use material wastefully in order to save time. So if you have, they will use the which is a large quantity. If you got some waste, they will throw out and they will not use it because they want to produce more. They will use large quantity, and if you come waste, they will not reuse, and it will take time consuming, so they will not get more bonus. Next, cutting sale prices. If you cut the sale prices, you will get the demand. When you price is low and demand will be high, from the customers. Favorable sale value variance. Next, simply favorable sale price variance may result in adverse sale value variance. Next, interpretation of variances. What is this interpretation of variances? That is, may be material price variance and material usage variance. Price means price, usage means quantity. Here might be caused due to different suppliers. So if you are purchasing from one supplier, you get the purchasing power, so you will ask for more discounts, you will get for less price. Then if you get for less price, you will get have more profits. If you are purchasing from different customers, you will get the price. You will estimate 10 rupees, so our supplier he is selling 10 rupees only, so he will give 1 rupee discount normally, so we will budgeted for 9 rupees, but we will go for another supplier, we are new for the supplier, so he will sell 12 rupees. That is the due to different suppliers. Next, order size can result in variance. When you are ordering for a huge quantity, that is large quantity, we will get more discounts. For budgeted, we will see that we are producing 10 lakh units, so the 10 lakh units we will discount will be provided, but in actual position we will take that 10 quantity in different time. When you are taking different time, we will not get the discount. So no, order size, based on order size we will get the material price variance. Next, any form of unexpected increase in buying cost of higher delivery charges. Sometimes there may be a problem of transportation, so no transportation is available, then at that time transportation cost will be increased. Next, efficiency or inefficiency associated with the buying producer adapted. What is the procedure they adapted? Based on that also price will be change. Next, lack of appropriate inventory control can result in emergency price material of resulting. So you are using the just in time. When your product is completed, then you are ordering, then there will be when your emergency is there, you are ordering, then it will be price will be increased and cost will be increased. Next, material usage variance. When will come material usage variance? Use of inferior quality material. So you are using the material quality, inferior quality materials, and implementation of better quality controls. Next, increased efficiency in production can help in bringing down the wastage rates. So efficiency production is main important. Next, changes made in material mix. So you are using A and B, now you are producing A and B and C, that is change in mix. Next, careless way of handling material by production department, then material may be wasted, then variance will be come. Next, change in method of production or design. So you are changing some design materials. Next, pilferage materials means small theft is going on from production department. Poor inspection, they are not inspecting. Next, labor rate variance. Why the labor rate variance is come? Unexpected increase in the pay rate of laborers. So labor is going for strike, they want more wages, then we will require to pay more wages, then our labor rate variance will be come. Next, level of experience of labor can impact. If our senior executive and he have more experience, he will work more and he will produce less time, more quantity. For if you take new customers, if you will get the more cost. Next, payment of bonuses added to the direct labor cost. Next, change in composition of the workforce can impact direct labor cost. Next, labor efficiency variance. Efficiency variance, here improvement in work or productivity efficiency and workforce mix. If you mix one workforce, then it will be labor efficiency levels. Next, industrial actions in relation to workforce. Poor supervision of workforce. Learning curve effect. Learning curve effect means if you take 100 hours for first time and second time it will take 80 hours, third time you will take 60 hours, that the case your time will be decreased for same quantity. That is learning curve effect. Resource shortages causes unexpected delay in lowering of labor efficiency levels, using inferiority quality of materials, introducing new machinery resulting in improvement of labor productivity levels. Next, variable overhead variances. Why the overhead variances is there? Fixed overhead expenses adverse are caused by spending in excess of budgets. So fixed overhead variance is caused by changing production time, production volumes, and variable overhead expenditure variance is often caused by changing machine running cost. So machine running cost is different, then variable cost will be increased, and variable overhead efficiency variance cost is similar to those direct labor or efficiency variance. Next, sale price variance. Why the sale price will be variance? Why the sale price will come difference? So you decided 9 lakh 50 10 lakhs quantity, you must say first 10 lakh quantity you decided 1% discount. By in real case they are providing 2 to 3% discount, though they are providing higher discount given to the customers in order to encourage bulk purchases, and effect of lower price offered during market campaigns. So when you want to promotional product, you must sell at a low price, and sometimes you must give at a free of cost also. Next, poor performance by salespersons. Salespersons is not providing sales, they will not taking goods into the customers. Next, market conditions are economic conditions forcing changes in price across industry. Next, sales volume forces. Value means what? Quantity. Why the quantity will differ? Here successful or unsuccessful direct selling efforts. Next, successful unsuccessful market efforts. So effect of advertising campaigns. You do not have effective campaign. You are not going for marketing advertising, then your quantity will not be sold. Unexpected changes in customer preferences and buying patterns. Next, failure to satisfy demand due to production difficulties. Next, higher demand due to cut of selling price. If your house selling price is less, demand will be high, and or lower demand when increase in sales price. Next, illustration number 6. If they provided illustration number 6, illustration number 6 we will see in next video.